Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending March 3rd, 2023. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Russell 2000, and the Nasdaq were all up, mostly in the last 2 days of the week, on easing fears of interest rate hikes in the US and economic data released on Friday, which showed steady demand for services, with Purchasing Managers Indexes (PMI) from the Institute of Supply Management and S&P Global indicating that activity in the sector continues to expand even as input prices cool, which is good news all around. Gold and oil were also up for this week. Turning to Canada, the Canadian GDP report on Tuesday came in with the year-over-year GDP for Q4 was up 2.07%. The GDP quarter over quarter for Q4 was a zero, and GDP month over month for December was actually a negative 0.1% with a positive 0.1% expected. The GDP annualized quarter over quarter for Q4 was a zero with a 1.5% growth expected, which means we were lower than expected and generally flat, but not negative in terms of a possible recession, which requires 2 negative quarters in a row. The Canadian dollar is weakening again due to the expected interest rate hikes in the US, which cause more people to take their money to the US for higher interest rates in the US savings account. That makes US products more expensive for Canadians, and we end up importing the US inflation, which has caused the US rate hikes in the first place. Canadian banks reported this past week and as a group sold off for various reasons. They left larger than expected reserves for bad loans, hurting the bottom line, or they didn't seem to get as much as they should have from the higher interest rates for their loan margins. Wealth management also suffered, and the banks that had US businesses did better because of the higher interest rates than Canada in the US on mortgages. The federal government's foreign homebuyer ban was designed to improve housing affordability, but a major flaw in the legislation is causing more harm than good, according to the Canadian Imperial Bank of Commerce. The ban, which blocks non Canadians from buying residential property, either directly or indirectly, for 2 years, came into effect on January 1st. The Prohibition on the Purchase of Residential Property by Non Canadians Act, as it is officially known, was meant to take some pressure off home prices amid an affordability crisis, only made worse by the rising cost of living brought on by inflation and elevated interest rates. But there's a problem. The language used in the act is causing issues and it's stopping real estate development necessary to boost housing supply and address affordability in its tracks. Benjamin Tal of CIBC Economics said in a note, quote, "The language of the act appears straightforward until you show it to a lawyer," end quote, he said. Further, the definition of, quote, non-Canadian, end quote, is also a source of problems. Corporations are considered non-Canadian under the Act if they have foreign ownership of at least 3%. But though the Act excludes companies listed on a Canadian stock exchange from being affected, it fails to exclude real estate investment trusts, or REITs, which are important builders of residential properties such as apartments. That means most publicly traded Canadian REITs are therefore considered, quote, foreign entities, end quote, the note said. As a result, many REITs risk being blocked from building much needed new housing. Turning to the US, the bond yields are becoming competition for the stock market especially the interest cash flows of the bonds compared to the low dividend yields from US stocks. The 2-year US government note paid 4.82% interest this week, and the 6-month T bill was over 5% this week. A 0.5% rate hike in March by the US Fed is expected by some analysts. At least a 0.25% rate hike is almost a lock. A grand total of another 0.75% total raise from here is expected before the US Fed pauses. Just weeks after General Motors executives said they weren't planning any layoffs, the company laid off about 500 salaried employees. The cuts come on the heels of performance evaluations, and they are part of the company's plan to trim $2 billion in costs over the next 2 years. The layoffs affect a, quote, small number of global executives and classified employees following our most recent performance calibration, end quote, according to internal company communications. The auto industry had largely avoided layoffs until recently, with major technology companies dominating the news about job cuts. Last month, the GM rival Ford said it would slash about 3,800 jobs in Europe. In just about a month, US mortgage rates have risen a 0.5 percentage point, and that has pushed demand for mortgages to buy a home to a 28-year low. Mortgage applications to purchase a home dropped 6% week over week, according to the Mortgage Bankers Association. Demand is down 44% compared to the same period last year when rates were in the 4% range. In the US, mortgage rates topped 7% this week. Rivian, the upstart EV truck maker, reported lackluster earnings Tuesday while also forecasting a lighter than expected production output for the year. Rivian said it expects to produce 50,000 vehicles this year, well below Wall Street's estimate of about 60,000. The company blamed supply chain issues for the recent hiccups, as suppliers were short on certain components. While the company is a little gloomy about this year, it does see some silver lining. Quote, "We expect supply chain challenges to persist into 2023, but with better predictability relative to what was experienced in 2022, end quote, Rivian said in a letter to shareholders. More layoffs are happening at Twitter, Meta, and Palantir in the technology sector. They are focusing on cost cutting and improving margins. Turning to some bits and pieces, emerging economies led by India and China are supplying much of the momentum for global growth, and the International Monetary Fund projects they will account for about 4/5 of the global growth this year. If you are upset by your grocery bill increasing, you have no cause to complain. The World Bank Group February 2023 report on food security has shown that food inflation has been rampant elsewhere. There is high inflation in almost all low and middle income countries, with inflation levels above 5% in 88.9% of low income countries, 87.8% of lower middle income countries, and 93% of upper middle income countries, and many experiencing double-digit inflation. And finally, looking at next week, we have companies reporting. On Monday is Element Fleet Management and Cargojet. On Wednesday, we have the Granite REIT and Nuvei. Thursday is Oracle, JD.com, and a bunch of Canadian miners. Looking at economic events for next week, on Monday, we have the Canadian Purchasing Managers Index. On Tuesday, the US Fed Chair Powell testifies in Washington. And on Wednesday, we have the Bank of Canada interest rate decision, which is widely expected to have no change in the rate. And also, we have US oil inventories. On Thursday, we have US initial jobless claims. And on Friday, we have US payroll data and US and Canadian unemployment data. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.